On Monday, February 23rd, Visa dropped 4.5%, Mastercard dropped almost 6%, American Express dropped over 7%, IBM crashed 13%, its worst day since the year 2000. The Dow fell 821 points, and all of this was triggered by a Substack article. Not Goldman Sachs, not the Fed. A Substack newsletter called Citrini Research published a report called the 2028 Global Intelligence Crisis, and it spooked billions of dollars out of these stocks in a single day. Michael Burry, the big short guy, shared it directly on X with a chart from the report and wrote, "And you think I'm bearish." That same day, Nassim Taleb was separately warning about software bankruptcies at an investor conference in Miami. Bloomberg linked both as co-catalyst and the sell-off snowballed. The White House called it science fiction. So I read the whole thing and I wanted to break down what it actually says, what's real, what's overblown, and what it means if you own any of these stocks. Here's the core thesis. It's actually very simple. Right now, every time you tap your credit card, the merchant pays a 2 to 3% interchange fee to Visa or Mastercard. On a $100 purchase, that's $2 to $3 going to the card network. That fee is how Visa and Mastercard make most of their money. Citrini's argument is, what happens when AI agents start handling our purchases? These agents think of software that shops for you, compares prices, handles subscription. They don't care about your credit card rewards. They are optimizing for the cheapest, fastest way to move money. And they would quickly figure out that 2 to 3% per transaction is an absurd cost when alternatives exist. The alternative? Stablecoins. Digital dollars that run on blockchains like Solana, where the transaction cost is $0.007 and settlement takes 400 milliseconds. Not 2%, not 1 to 3 business days, fractions of a penny and under a second. Citrini says that by 2027, AI agents would start routing transactions through stablecoin instead of card networks. They flagged Mastercard's Q1 2027 earnings as the point of no return the moment the market would realize this shift is real. And they say American Express gets hit the hardest because AI is also replacing the white-collar workers who are Amex core customer base. Double whammy. Now, this is important. Citrini explicitly called this scenario not a prediction. The report is written as fiction set in June 2028, looking back at what happened. Van Gelen, the founder, said he was shocked that it triggered an actual sell-off, but the market didn't care about the disclaimer. So is any of this grounded in reality? Actually more than I expected. Stablecoin transaction volume hits $33 trillion in 2025. That's up 72% from the year before. For context, Visa processes about $15.7 trillion a year. On raw volume, stablecoins have already passed Visa. But here's the catch, and this is where the headline is misleading. Most of that $33 trillion is not people buying coffee with crypto, it's DeFi transactions, trading, and treasury movements. The commerce piece is still tiny. Where it is real business is business-to-business payments. B2B stablecoins payments went from under $100 million a month in early 2023 to over $6 billion a month by mid-2025. That's a 60x increase in 2.5 years. Cross-border payments are where stablecoins are genuinely eating into traditional rails right now. And there's real infrastructure being built. Google and Coinbase launched something called the AP2 protocol in September 2025. It lets AI agents make micropayments using stablecoins. The launch partners aren't crypto startups either. It's Lois, Salesforce, ServiceNow, and WorldPay. It is not vaporware. McKinsey sizes the agentic commerce market at $136 billion today, growing to $1.7 trillion by 2030. That's a 67% compounded annual growth rate. So the trend is real, the question is timing. Now, here's what Citrini gets wrong, or at least what they are way too early on. A blogger named Zivi Moshkovitz wrote probably the best rebuttal. His core point: credit cards aren't just payment rails. They bundle four services together: payment processing, credit and lending, fraud protection with chargebacks, and dispute resolution. Stablecoins only do the first one. Think about it. If you buy something with a credit card and it never arrives, you call your bank and get a chargeback. If you send stablecoins to the wrong address, that money is gone. Blockchain transactions are final. There's no customer service number for the Solana blockchain. And here's the thing most people forget about rewards. Those 1 to 5% cashback programs are funded by interchange fees. Kill interchange and you kill the rewards. Consumers are not going to voluntarily give up cashback to save merchants money on processing fees. Then there's the practical stuff. Most consumers don't hold stablecoins. They don't want to hold stablecoins. Converting from dollars to stablecoins adds friction and cost. And tap to pay with a credit card is already frictionless. It's hard to make something easier than tapping your phone. On the regulatory side, the Genius Act, the first US stablecoin framework, was signed in July 2025, but the implementing regulations aren't even final until mid-2026. With enforcement starting in January 2027, the regulatory infrastructure is still being built. Here's what I found interesting. Visa and Mastercard are not ignoring this. They are co-opting it. Visa already has USDC settlement live in the US running on the Solana blockchain. They are doing $3.5 billion in annualized stablecoin settlement. They are adding support for multiple stablecoins and adding and expanding to more blockchains through 2026. Mastercard is doing the same thing. They have enabled multiple stablecoins across their network. They are piloting with Ripple. They have launched a multi-token network for programmable payments, and they were rather actively hiring for stablecoin and DeFi roles as of February 2026. Their strategy is basically, we don't care what rail moves the money, whether it's traditional card networks, ACH or Solana, we will build trust, compliance, and identity layer on top of whatever rails wins. You still need fraud protection, you still need compliance, you still need dispute resolution, and that's where the card networks plan to extract value. So here's how I see it after digging through all of this. The thesis is directionally correct. AI agents and stablecoins will put pressure on interchange fees. The economics are too compelling to ignore. Paying 2 to 3% when the alternative cost a fraction of a penny doesn't make sense for machine-to-machine transactions. But the timeline is at least 2 to 3 years too aggressive. And here's what I think actually happens. Right now, through 2026, it's infrastructure phase. B2B cross-border adoption accelerates. Visa and Mastercard integrate stablecoin settlement. The plumbing gets built. Consumer impact is minimal. 2027 to 2028, machine-to-machine payments via stablecoins becomes standard for AI and API commerce. You start seeing the first consumer stablecoin checkout options, probably through hybrid card products. Interchange pressure increases, but it's manageable. 2029 to 2030, this is the real test. If AI agent adoption goes mainstream, maybe 5 to 15% of consumer spend starts routing through non-card rails. Card networks survive because they own the trust layer. Interchange rates compress but don't disappear. For Visa and Mastercard holders, this is not an imminent existential threat. The Citrini sell-off was probably a better entry point for longs, not a short thesis. But cross-border revenue, their highest margin segment, is the most vulnerable piece long-term. The leading indicators to watch isn't AI agent adoption matrix, is whether Amazon, Walmart, or Shopify start offering stablecoin checkout at a discount. That's when you know the shift is real. If this kind of breakdown is useful for you, where I take a complex financial topic and try to actually make sense of it, I'm going to do more of this, so subscribe and I'll see you in the next one.